My name is Andrea Medina Vera, and I'm an early career education specialist with CDSPI Advisory Services. So, thank you so much for joining us tonight. Tonight's conversation follows a path that many dentists move through as opportunities come up. We're going to start with the agreement itself, what's in it, what might be negotiable, and what can limit you later. Then we're going to move into income and planning because the way you're paid, of course, affects budgeting, debt saving, and protection. From there, we're going to look ahead to ownership considerations, even for the people who are not planning to buy right away. Then we're going to leave time for Q&A. To help us explore these topics, I'm joined by three experts who bring a different perspective to the conversation. And I'll give them a moment to introduce themselves, maybe starting with Michael.
Thanks, Andrea. Michael Beard. I'm a partner in the corporate commercial group of the Edmonton office of Dentons Canada. So I do general corporate commercial work. I've got a specialty in dentistry. So do a lot of assistance with associate agreements and then also tax-related issues and buying and selling practices. So really most issues that dentists encounter, I deal with as well.
Thanks so much. And let's move it to Matt.
Hi, everybody. Welcome. Thanks for joining us tonight. My name is Matthew Wright. I'm one of the investment advisors at CDSPI. Some of you may have seen me at some of the dental schools already, but my clientels are, dental students to late-stage retirees. I'm based in Ontario primarily, but again, my clients span nationwide.
And then Anca.
My name is Anca Poirier. I am an insurance advisor with CDSPI and have worked exclusively with dentists for over 20 years now. I work and advise on both life and disability insurance products, as well as general, such as the triple guard insurance for the dental practice. And I specialize in insurance for build out. So whenever building a practice from scratch, what's needed, connecting with contractors, and pretty much helping dentists throughout their careers with knowledge accumulated over the years.
Awesome. Thanks so much, everyone. We'll get into the questions right away. Our first set of questions is all around associate agreements and structural risk, because for a lot of new dentists, an associate agreement is one of the first major professional documents you're going to sign, and it's going to shape more than just where you work. Your agreement can affect your income, your schedule, your ability to leave, where you practice next, and how much flexibility you have if things change. So before we get into the details, I want to start by building a fuller picture of what's really inside these agreements, what's negotiable, and where early career dentists can sometimes get caught off guard. So our first question today is, what clauses should early career dentists pay the most attention to before signing an associate agreement? And that question is for Michael.
Thanks, Andrea. And before I get into it, I should probably just note that I'm located in Edmonton, like I mentioned. So what I see and what I deal with typically is Alberta agreements. So what I am going to talk about today applies to Alberta agreements for sure. Broadly speaking, I think the same general principles and issues come up kind of across Canada, but just wanted to flag that I am kind of Alberta specific, and this is from like an Alberta specific perspective. So having said that, a few key things to be on the lookout for in associate agreements. One, compensation structure, obviously. Again, in Alberta, it's pretty standard that it's going to be 40% of like accounts receivable actually collected by the owner. Some things that are more variable, restrictive covenants. I think most people generally have a sense of what these are, but they're non-competition, meaning like a covenant stopping you from working in or around the area where the clinic is. And then there's non-solicitation, which prevents you from contacting any patients of the clinic or soliciting any staff, like trying to get staff hired away from the clinic you were working at to a new clinic. Those are important to think about, and we can maybe talk about those in a little bit more detail later. Couple other things to be aware of: termination provisions. So again, in Alberta, there's usually kind of standard periods. It's usually just a notice period between 30 and 90 days. 30 is probably the most common, but you can see up to 90. And typically, both you as an associate have a termination right and the owner has a termination right. Each can be triggered just upon written notice to the other. So one important thing to keep an eye on is those should be the same length of time. A lot of the time you see kind of owners where they can terminate you on 30 days notice, but you can't terminate your agreement except with 90 days notice. So ideally, you obviously want that to kind of be reciprocal in terms of the time period that you're looking at. And then maybe one more thing to be aware of generally is if there's a holdback on termination. So you don't see it in every associate agreement, but it is pretty common here in Alberta that if your agreement's terminated, the owner has a right to hold back a portion of the money otherwise payable to you, kind of a security in case there's any corrective work required. And I'll say generally that's a reasonable concept that you see, but you just want to make sure that the parameters of that aren't too extreme. So what I mean by that, there's kind of two aspects of it. There's how long they can hold the money and how much money they can hold. So in terms of how much money they can hold, usually you see it as like a percentage of all accounts receivable. See somewhere maybe between 50 and 25% of the amount that's actually owed you. Obviously, the lower that percentage, the better. And then in terms of the time, I've seen everything from 3 to 12 months. You typically don't want to agree to something longer than 6 months unless there's some sort of specific reason that you would be required to agree to that.
Awesome, thanks so much. And then when you're reviewing these clauses, are there any that seem harmless at first but can really limit someone later? What are some common pitfalls?
Yeah, so one that hold back on termination, something to kind of be aware of because a lot of people kind of just gloss over it, and then if your contract is terminated, especially if you're now dealing with maybe financial pressure, like we were alluding to before, having additional funds being held back is not ideal in that situation. So again, kind of important to pay attention to it on the front end. A pretty simple one, but one that kind of trips people up sometimes is just vacation and scheduling. Just making sure, hey, how much vacation do you get? What is the process for needing to approve that vacation with the owner? And then what is your scheduling going to look like? And is that ideally, you don't want it all in the owner's discretion. You want it to kind of be something that you work together with reasonably. And most owners are pretty reasonable about that. But I've certainly seen instances where they're not, and where people don't kind of pay attention to those provisions up front because they kind of seem less legally than some of the other ones. You can get yourself in a situation where you're limited in terms of how you can take vacation and time off and how much notice you need and everything like that. And then I guess the other big common pitfall is just on the restrictive covenants. So this also varies a little bit province to province. But there is also an aspect to consider about enforceability. But broadly speaking, you don't want to be agreeing to like a very large territory where you can't compete because it's obviously going to limit where you can go and work after you leave. So what is a reasonable territory for these non-competes kind of depends on the area. So like in rural areas, you usually see a larger territory. 10 kilometers maybe. Again, it's really depends on the territory that you're in. More denser urban centers, usually we're talking like 1.5 to 3 kilometers for like a non-compete radius. And then in terms of the duration for your non-compete, should not be longer than a year, I would say, for any associate agreement. And sorry, I should expand on that. While you're working at the clinic, it's in effect. And then for a period of up to a year after you.
Okay, awesome. Sorry, thanks. I thought the audio cut out there, but I appreciate it, Mike. Kind of grilling you here at the first half, but really appreciate your knowledge. Our next question is how negotiable are these associate agreements? Realistically, especially for new dentists, or if this is your second associate agreement that you might be looking at, what would be the best way to approach that negotiation conversation?
Yeah, no, it's a good question. It kind of depends, I guess, is the answer. So there's almost kind of two buckets in my mind of owners that you can be dealing with. You can be dealing with private practice, like just a simple dentist who owns a practice or a number of practices, or a DSO. And typically the negotiations with the DSO can be tougher than with a private practice dentist, but it depends on the dentist. So there's usually room for negotiation. Maybe they don't want to get into like a full-blown negotiation, especially DSOs. But I find the best approach is whether you involve counsel or not, kind of choosing a few key issues that are important, like including some of the ones we were talking about before. And then either depending on your relationship with the owner, you can kind of talk to them owner to owner, or you can go through lawyers as well, or a lot of the time, if you use a lawyer, you can just kind of get comments and filter those back and forth with the owner. That sometimes is a friendlier approach than trying to have like lawyers email each other with associate agreements. Um, and again, depending on your relationship and dynamic with the owner, there's a couple of ways to kind of couch these things. One, you can just say, hey, this is what I've seen to be reasonable. I have colleagues who have a termination period of 30 days instead of 90 days, or vice versa, depending which side of the termination agreement or termination provision you're talking about. You can also be candid that you talk to a lawyer and your lawyer advised you, hey, here are some kind of key issues in terms of things you should look out for, or what's market versus not market. And then also, if it's not your first agreement, I find that it's often useful to flag, hey, in my previous agreement, actually, it was like this, which I thought was fair, or in my discussions with the other owner, they agreed that this was fair. So, big picture, they are negotiable, though usually the owner doesn't want to go through every provision of the agreement with you. Kind of have to choose your battles, and then depending on the dynamic with the owner, you can kind of use different reasons for why you're flagging things to change.
Awesome, thanks so much. And then you just mentioned DSOs versus like a dentist on practice. So when it comes to the type of practice arrangement, what should someone be watching out for?
Yeah, so I touched on it a little bit. Basically, I would be a little bit more wary with agreements with DSOs. Like, one, they're stricter, they're usually more difficult to negotiate with, and they're usually trying to put more stringent terms on you. So specifically, we kind of talked about these before, but like restrictive covenants, I would pay specific attention to with DSOs, and probably both the duration of the restrictive covenant and the territory of the restrictive covenant are longer and broader than they should be, and you should push back on that a little bit. Similar for termination, you want to try to make sure that you've got an equal period there, and you want to look at what the holdbacks are. Again, the potential holdback they can do if there's a termination, because they do, again, they want a larger quantum than I would say is typically reasonable, and a larger period than what I would say is typically reasonable. So specifically with DSOs, I would kind of have an eye out for that. And DSOs want to negotiate even less than private dentists do usually, but if you do limit it to kind of certain key issues, and they kind of know too where they're being unreasonable generally, I found that you can have success there.
Awesome, that's good to know. For our next question, this one's also addressed to you, Mike, but also Matt. If an associate agreement ends unexpectedly, what should someone be financially prepared for, or just prepared for in general?
Yeah, maybe I can start and then Matt can get into the maybe more of a useful answer even, but same things that we talked about before. So restrictive covenant, where are you now limited from working, and making sure that you're not breaching the non-solicit in terms of going after patients of the clinic or trying to get staff to come to a new clinic, and then really being aware of what that potential holdback might be in terms of income that you thought you were getting from work already done that's maybe now being held back pursuant to the provisions of those holdback provisions.
Yeah, it's the ability not to work can be stressful no matter what the industry is, right? So, be prepared for that. Highly suggest build an emergency fund of, at least 3 to 6 months, at least 3 to months worth of your fixed expenses. Map out what you need over the course of that time. As Michael alluded, don't necessarily count on that last paycheck. There could be a lag for it if you do get some of that back, but you should be prepared going into that if you can. And looking at that Kahoot question we had earlier, it is stressful, right? Your ability not to have an income. So it's not too late to start building up that emergency fund. But if this were to happen, again, map it out. If you can cut back on anything, that's ideal. You're likely not going to contribute to things like, your RSP TFSA for that time being. So you could, tone that back a little bit and hopefully have a little bit of a surplus in your pocket for the time you're not working. And then as for your loans, if you can drop it down to interest only, for example, maybe you can save a little bit there as well. So, reach out to your lender if you do have a substantial amount of debt and see if they can offer you something during this transition period, because it could help you out in the shorter term.
Thanks so much, guys. And that's a lot of focus on like the contractual and like income side, but when it comes to income risk, when someone wants to work but physically can't, what are the biggest threats to a dentist's earning potential and how can they protect against them? And this one will be for Anca.
Happy to answer this one. So I would say that other than the contractual risk that we touched on, the 2 other major risks to the earning potential would be your health and unexpected practice closures due to physical damage, such as a fire or a flood to the practice. When it comes to health, even something of seemingly minor, like a skiing accident, can, or when the wrist fracture, for example, can leave you without an income for up to 6 months. Not to mention lots more serious conditions that can affect your earning potential for years, or even derail your career as a dentist. And for the health perspective, insurance is a great tool to transfer that risk, disability insurance in particular. And the CDSPI has a wonderful product for disability, the Disability Guard. One of the advantages would be that both the advisors and the claims adjudicators have deep knowledge of dentistry. We work only with dentists. And our policy is probably one of the best out there. We still have the own occupation option included. And what that means is that if you cannot practice clinical dentistry due to a physical health concern, and you start earning income from a new occupation like teaching dentistry, the benefits you receive from our disability would not be reduced by the newly earned income. Another advantage is that our policies are priced very competitively. It's group insurance, so great rates, and our policies are guaranteed and non-cancelable. And taking into consideration that dentists tend now to work longer till later in life, our policy also extends up to age 75, where most others end at 65. And I believe there are some students in our audience as well. And if you're not aware yet, CDSPI offers no cost coverage to dentists in dental schools. And those coverages continue, and they have a lifetime discount for disability for 15%. So it's a great idea to get that when you're young, lock in the premiums and the discounts, and then you don't need to worry about that later on. And when it comes to the other risk mentioned, the practice closures, an associate should be aware of the fact that the policy the practice owner has in place will not cover your income in such situations, but only their employees. As an associate, however, there is insurance available. There's a product called Triple Guard Associate, and that would reimburse your lost income up to 12 months until your practice is operational again.
Awesome. Thank you so much. So that's the first section of our panel where we're really focusing on the legal side and the contracts. These next set of questions is going to focus more around financial momentum, especially in those first 5 years. But if you're beyond that stage, the same ideas still apply because when income changes, contracts change, or ownership starts becoming more realistic, the point isn't that every decision has to be perfect early. It's that early patterns can create that flexibility or make later decisions harder. So we really want to emphasize that. So with that, what makes the first 5 years financially powerful, even if income is still changing or isn't at its peak yet? And
Yeah,
this
I'll
one,
jump on that question.
sure, thanks.
So your income's gonna drastically go up from, by the time you finish residency to signing that contract. It's gonna fluctuate, call it those first couple of months, but it's gonna go up substantially. So mapping out those first 5 years is very important. Reaching out to an advisor, reaching out to an investment advisor, say at CDSPI, for example, we can help you map that out. It's not too early for a financial plan. We can see what those first 5 years look like. Everybody's situation is different, whether you're living, still at home or you're branching out after that. You have the potential to have a massive surplus in those first couple of years if you keep expenses relatively down. And you can do a couple of things with that. I mean, we'll take a look at that in some of the next questions, but you can focus on things like investing and paying down debt at the same time. You could aggressively bring it down and invest. So, we'll look at it in a little bit, but you don't want to do one thing over the other. So you want to find that balance. That's what we can help you out with. And, there's different vehicles that you can amass this, you can accumulate wealth in, whether it's an RSP or TFSA, or even you're thinking about incorporating at, a certain point. We'll have those conversations. And, again, those first 5 years is crucial to start having these conversations. And although you may not be, fully topping these accounts up at that point, just having these conversations and setting up for success goes a long way down the road.
Yeah, thanks so much, Matt. And on that note, how should early career dentists think about balancing debts, saving, and investing without feeling like it has to be all or nothing? And is there any changes between maybe an early career strategy versus a mid-career strategy?
Yeah, again, I mean, the plan can identify those things. We can categorize certain debts. We can attack certain ones with higher interest rates, and kind of map it out and see how it looks like. Federal loans treated differently than a bank loan, for example. One could be interest free for X amount of time versus you're paying interest on, a larger bank loan, for example. So, we can map that out and see what it looks like. But again, you don't want to just focus on one versus the other. Compound interest, it's real. It's a powerful tool. The idea of compound interest is earning money on your money, right? Think of it as a snowball. It keeps on getting bigger and bigger. So again, the sooner you start to think about investing, the more time your assets have to grow. Time in the market is more important than timing in the market. So, those are, again, conversations to be had, and we can figure out what the right account type is for you at that given point. Again, whether it's a TFSA, RSP, first-time home buyers, investing in the corporation, we can take a look at that. I have a good dental analogy just to explain compound interest as well. So, you can kind of compare it to, plaque accumulation. A small amount of uncleared plaque builds a rough surface, so it makes it easier for more plaque to build on it. Well, that's kind of like investments, right? Your money works the same way. It builds that foundation and it attracts more. So it's going to keep on building up over time. So again, starting 5 years sooner than when you expected really goes a long way down the road. It could be a difference of tens, if not hundreds of thousands of dollars. And you won't have that need to catch up if you start, say, investing in an RSP at age 45 when you started 10 years sooner. So it does make a huge difference.
That's a really awesome analogy, Matt. I think I'm gonna have to steal that one with the clock. That's great. Um, for our next question, we're going to go to Anca. So from a protection standpoint, because we just talked about different strategies and things, but from a protection standpoint, what is easier or more advantageous to set up sooner rather than later?
I would say that any medically underwritten insurance policies should be secured first, because this way you ensure your insurability. So you lock in rates and insurance policies based on your young age and health, and avoid having stress further down the road when other things may come up. And I did mention a bit the own occupation option for disability before, but another option that's quite important is called future insurance guarantee. That should be included in any disability policies, because this allows you to increase your insurance benefit to keep up with your income. So as your income goes up, so will your disability benefit. And this option allows you to increase without having to go through medical every time. So you can increase your income every year until age 55 with no medical. And it's not only about the convenience of the process of the increase, but if you develop a medical condition that would not allow you to increase your coverage otherwise, your disability would remain at that initial level, which would no longer match your standard of living. And another type of coverage that you should consider early is life insurance, because if you, and probably you will buy a practice, one of the conditions for the purchase would be to have a life insurance policy assigned to the bank as a collateral, so that their financial interest in your practice is protected. And it's a good idea to avoid the stress later on and not jeopardizing possible deals, because you cannot have that insurance in a short time.
Amazing. Thank you so much. That's super insightful. And then we have one final question for all of our panelists before we move into the Q&A. I do see we have a couple of questions in there already, but leaving everyone with just things to think about. For someone who might want to own a practice one day, even if it's not soon, what's something that they should or could be doing right now so that they don't limit their options later?
Yeah, so I can start. Similar to some of the things we've talked about already, being aware of restrictive covenants. So you don't want to limit yourself in terms of where you can buy a practice because of a non-compete. And you don't want to restrict yourself too much with non-solicitation, either with staff or patients, because that may limit your options if and when you're trying to open or buy your own clinic in the future. Uh, Less of a legal point maybe, but like if you are interested in buying a practice, I would kind of observe the owner, kind of see what it's like dealing with staff, like the additional financial considerations, the kind of the management aspect, because that is going to be very important. If you're considering owning a clinic with someone else, I would talk to really like a lawyer is probably the best bet in terms of what your shareholder agreement options are and what those can look like. Because just to summarize at a high level, if you're going to own a clinic in partnership with someone else, you're going to need an agreement kind of governing your rights and obligations just in case there's any sort of issue in the relationship later. And then again, this is not necessarily legal, but like if you are interested, I would engage a dental broker sooner rather than later. Dental brokers for prospective buyers, they're not going to charge you anything. Like they get paid by the sellers. They're just trying to look for people interested in buying. So they'll be happy to engage with you. They'll be happy to give you some information just so you can kind of get a sense of what's out there and what the financials and everything might look like. And I'll say as well, I'm sure everyone on this call, if you don't know a dental broker, would be happy to give you a recommendation.
Thanks so much, Mike. Matt or Anca, the floor is yours.
Sure.
I
Yeah.
can jump in.
Kind of along the same line. Oh, sure. Yeah. Get your people, get your network in order. It's never too early for that. You know, CDSPI is a great resource for these contacts. Whether it's Michael on the legal side, we can put you in touch with accountants if you need financing as well. That's somebody else we can set you up with. But you know, find these people and start having these conversations. Again, it's never too soon to start thinking about this. And then just jumping ahead, I mean, maintain your credit worthiness. I mean, banks can finance 100% of the purchase practice, but you know they're not going to finance your initial cash flow or the expenses to do that. So you know, you need to do a couple of things to obviously prepare for this purchase. Again, have that emergency fund. Prove to the bank that again you are creditworthiness. So you know, just things along that nature. Just keep your finances tight up until that point, and you should be in good hands after that.
Thanks so much. And then Anca, closing thoughts?
Yes. So other than what I already mentioned, ideally having the medically underwritten policies ahead of time. So other than life insurance as collateral, the bank will likely ask for proof of disability insurance. They do not generally mention how much. So even having your initial policy that you had as a student, it will avoid a lot of stress in the negotiating phases. Also be aware that depending on whether you are going to buy an operating practice or building a dental practice from scratch, the insurance requirements are quite different. So for an operating practice, what you'll be asked to have is fire insurance and commercial general liability, which doesn't take long. It's not medically underwritten. You only need about 2-3 business days to put that in place. However, if you are building an office, it gets a bit more complicated because another type of insurance is required during the project. You need to coordinate with your general contractor, know the project details, and that requires a bit more time and effort. And lastly, I just wanted to mention that as a practice owner, there's another disability risk that you should be aware of, because not only you would have to make up for your own personal income, when you are a dental practice owner, you are responsible for ongoing overhead expenses, even while disabled. And there is insurance that covers that risk. It's the office overhead expense insurance, so that you do not have to dip into your personal savings to cover those expenses.
Awesome. Thank you so much. It sounds like if there's one resounding theme is please consult your professionals if you're not sure whether it's an insurance professional, your lawyer, or a financial planner to start putting those pieces together. We're here to support you, and you can reach out to us anytime. But before we move into the questions, I want to thank our panelists for sharing their insights and experiences with us this evening. Hopefully, tonight's discussion has given you some practical takeaways along with some things to think about as opportunities come your way throughout your career. With that, we'll open it up to questions. I see that we have a couple here in the Q&A. And the first one is for Michael. Non-compete clauses after contract is over or even during is not enforceable. It goes against mobility and work rights. So I guess like what are your perspectives on the enforceability of non-compete clauses?
Yeah, so I alluded to that before, and it will vary a little bit province to province. So, for example, I think Alberta kind of enforces them a little bit more than Ontario, for instance. Probably in Ontario, the chances are you could probably get anything struck down as non-enforceable in the context of an associate agreement. I'm not an Ontario lawyer. I wouldn't want to say that 100%, but kind of zooming out, generally, courts are reluctant to restrict someone's ability to work, right? Which is what the question is getting at. So there are, having said that, a associate is a contractor, they're not an employee. So tightly written restrictive covenants in certain conditions in associate agreements can be found to be enforceable. It's not just a blanket, you can agree to any non-competition agreement you want because it's going to be held unenforceable. That is not the approach that I would take. There is some, I guess, nuance in terms of how they're looked at. But again, I'll say this as an overall approach, it makes more sense to negotiate something that's reasonable and that you don't mind living with after the agreement, as opposed to executing an agreement with a broader non-compete where you then want to try to get it struck down for being unenforceable. Because even if you say a provision is unenforceable, that doesn't stop an owner from starting a claim against you based on that provision, right? And then ultimately, maybe if it got to court, the judge would say, yes, this is unenforceable. They can't stop you from working. Carry on. But the process of having to do that, or even kind of the looming threat, is typically not worth it when you can just negotiate something or be kind of clear about something from the get-go.
Thanks. And just more out of curiosity, in your experience, have you seen a lot go to court in that area, or do you find that they
I've
are able?
seen one or two over the course of my career, but usually it does not get that far, right? Because going to court for something like this, unless we're talking about big dollar values, depending on the practice and everything, is usually just not worth it for any of the people involved. But I have seen a lot of breach of a non-competition or non-solicitation covenant, and then a cease and desist letter, and then some correspondence back and forth between counsel. Like usually you don't actually get a claim filed, but kind of those preliminary steps and the headache and legal fees that go along with those, that I've seen quite a bit.
Thanks so much. Yeah, that's good to know because I think there is a lot of conversation about some people just think they're all non-enforceable, so it's good to get some context around that. Our next question is for Matt. How much is a financial plan and what kinds of things can you answer with a financial plan?
Yeah, that's a great question. So the low cost of $0. We are a member benefits. So this is a complimentary service for dentists. So yeah, we offer this complimentary for the dental community. Take advantage of it. It's a comprehensive exercise, and we can look at various things depending on where you are in your career. With dentists starting out, it could lead to a lot of planning around debt and investing. But that doesn't stop us from looking at other areas like saving for a practice, family planning, finding any gaps in insurance, being tax efficient. We can look at that. And then also, another piece is estate planning, right? So we can look at any and all of this. It's not just, we create this plan and it goes away, soon after. With a lot of my clients, we come back to it, we update it when there's big material changes, and it's basically a living document, right? So I guess how it works is we create the base and then we come back to it every couple of years, right? So again, it's not just set it and forget it. It's great to go through this exercise and really see what these numbers look like on paper and plan ahead.
Awesome, thanks so much. Yeah, as CDSPI, it is a member benefit to receive a financial plan if you're a practicing dentist. So whether you need one right now or you just want to ask some questions, feel free to email Matt directly or just email one of us at CDSPI, and we can definitely get you connected with some of our professionals. Similarly, in the legal space, I'm sure Mike has some colleagues across Canada that can also help with their situation if you're not located in Edmonton. And similarly, on the insurance side, we have folks that are licensed across the country to help facilitate those conversations. So I'm going to give it another minute for questions. Like I said, you can pop it into the Q&A at any time. But very briefly, just wanted to say that what we discussed in this presentation is for education purposes only. It does not substitute individual financial, legal, accounting, or tax advice. So if you do have any questions that are left over after today, please, please, please reach out. We're all very happy to help navigate your unique situation as well, because as you've probably heard from us in different panels, a lot of answers really do depend on your unique situation. So please don't be afraid to reach out. I see we might have another question here. Okay, yes, we do. This one looks like it's for Mike. Associate agreements sometimes have a 2-year clause, but also a notice period of 30 days. Is that enforceable?
Yeah, so I'm not sure exactly what that like a 2-year like a 2-year term on the restrictive covenant. We think that's what that means. And then a notice period of 30 days so I guess maybe I'll take them in pieces. And if I'm not answering your question, please feel free to send an updated one in the chat. A a 30-day termination notice period, that is enforceable. There's not an issue with that. Again, ideally, then that means you would be able to terminate on 30 days, but even if you weren't able to terminate on 90, except with 90 days or 120 days notice, that's maybe not ideal from your perspective, but that is legally enforceable for sure. If we're talking about then a 2-year duration for a non-competition provision, it depends on the details. That is more likely to be found unenforceable than another provision, depending on the geographic territory and maybe kind of some of the other circumstances of the relationship. It could be found to be enforceable depending on the province too, but it's certainly, I would say it's more likely that it would be found unenforceable, but again, not something that I would want to bank on or just assume that it was fine because it'll definitely be found unenforceable.
So, all right. It looks like we can wrap up for today. So again, thank you to our panelists for joining, and thank you to all of our attendees for spending some of their evening and night with us. If you have any questions in the meantime, please feel free to reach out to any one of us, and we are happy to help.